Yes, good evening, members. We welcome you with a very important topic, which is a very seasonal. It is on the tax audit close by close discussions on a very important clauses. We welcome you as there are the presence of our deputy conveners also. So we request deputy conveners C. Purvi Bagheera to if you can just switch on your camera, and we also welcome our co-deputy convener C. Vijayta Jaiswal ji. Vijayta madam, we welcome you. Right. So speaker for the day. He's just now only I came to know he's our own member and frequently is taking the sessions on the tax audit, right? And being a seasonal topic, I would not discuss anything regarding that subject. But before we start our today's topic, let's start the topic with our institute motto song. So we request all the members to please remain in the alert mode while we play our institute motto song as a mark of our respect. So I'm sharing my screen for the institute motto song.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, members. So now regarding the today's topic, being a close by close discussions on the tax audit, we all know that the tax audit we are doing it since long back. As I know that the tax audit initially it was introduced in the somewhere in the assessment year 85, 86, and this audit is specifically to ensure the proper tax compliances for the better administration of the law and to reflect the true income. But over the period of years, it has gained its own importance and the way the changes has come in the tax audit, right? So, and we are at the right time to take these sessions, being the tax audit filing seasons are very close now. So with this, first we'll have the formal introductions of the today's speaker. So I may request our deputy convener, CA Purvi Bagheera ji, since she is available today with us. So I request her to please, if you can just take the formal introductions of the today's speaker.
Thank you, Jayesh, for this opportunity. Today we have with us CA Yogesh Amal. He's a commerce graduate from the Mumbai University and a fellow member of the ICAI. He qualified in the year 2001 and is in practice since then. Presently, he is a partner at GBCA and Associates LLP, Chartered Accountants Mumbai. He has been instrumental in the GBCA's foray into business support service and outsourced CFO practice, and is experienced in managing audits of large corporates, including listed companies, multinational companies, and PSUs under various ERP environments. His area of expertise expands to providing accounting advisory services and is experienced in Indian GAAP, Ind AS, and IFRS. He has delivered talks at various seminars for professionals on tax audit, standards of auditing, Schedule 3, etc. Currently, he is member of Accounting and Auditing Committee at Chamber of Tax Consultants. In addition to contributions in various journals, he has also co-authored the following publications: the BCAS journal on anthology, on Ind-AS and disclosures, WIRC publication, BCA's publication on reporting under various, the new format of 3CD, the WIRC publication on Ind-AS and disclosures, and CTC jointly with Taxman publication, Comprehensive Guide on CARO 2020. Sir, we look forward to having a wonderful session with you on the tax audit provisions. And now may I invite you for your presentation. Thank you.
Yes, we welcome so before you just take you further, so we welcome you with a loud applause to CA Yogesh by Amal sir, our own member, is going to enlighten us on a very important topic as the Deputy Convener she discussed. And we request all the members to please put all the queries in the chat box. We have enabled the chat box for you only. You can put the relevant queries for the today's topic as per the available time. The speaker, we request the speakers to he will take all the important queries whatever time permits. So with this, we over to you, sir. You can now start your session, sir.
Thank you, Purvi, for the nice introduction. Thank you, JB Nagar and team for giving me this opportunity. Yes, I am a member of JB Nagar team, so it is actually a home ground for me, and I'm sure I'll be able to do justice to my fellow members. And at the same time, I look at this as an opportunity of learning, wherein there is a possibility that if I have not come across some situation and with these queries and discussions within this forum, I will also learn something new. So with this background, let me start the formal presentation. May I request all the members to please mute yourself?
Okay. Okay. इसका तो है मेरे ख्याल से 20 भी है.
Jayesh bhai, if you can centrally mute everyone from the admin panel. Okay. All right. So yes, before I actually start the technical session, let me give you some brief background about today's session. What would be the coverage of this sessions today? So as Jayesh bhai mentioned, that this is not a new subject. We had been doing this or dealing with this since years, and everyone is more or less accustomed to this subject. The coverage of today's session, however, would be on the important points which I had come across during my practical experiences, and which I felt that this was not a routine item or a routine transaction, and how did I deal with those specific items. This is one coverage as far as session is concerned today. To begin with, it would be broadly, I would take up the background, post the background, some applicability.
We request Kozim Topiwala sir, if you can just unmute yourself. If you can just remain muted, sir. Please remain muted. Sorry, sir. Please.
No problem, Jayesh. Then the applicability. Then look at a few important paragraphs of applicability, and then go through clause by clause each of the areas. Before I really start, let me inform members that we would not try to get into super technical discussion, which would lead the discussion to a different level. We'll try to refrain ourselves in discussing limited to the tax audit and not beyond. That is one. As far as queries is concerned, Purvi did convey that we can take up the queries during the clauses while we are discussing. And if any queries are unanswered or unaddressed, we can take those queries at the end of the session. Even if those queries still remain unanswered, I'll be happy to answer those queries offline. I will share my contact details, or they are already in the presentation. So yes, with this brief background, let me start the technical session. Jayesh bhai, I'm trying to share my screen. Let me know if the screen is visible.
Yeah, sure. So
is this visible?
Perfect.
It's visible, yes.
Okay. So as I was saying, let us first understand the brief background and the scope and the objective of this, from where this tax audit is coming. So basically, this tax audit is coming from a circular number 387 dated 1984. And by virtue of that circular, the objective mentioned, or rather coming up out of those circular, was that why this tax audit has been introduced was to ensure that whether the SSEs are maintaining the books and other records properly, whether the right incomes or deductions which are claimed by the SSE have been captured in, have been taken care of. If any fraudulent practices followed by the SSEs can be highlighted or will come up with this tax audit. All this activity in turn will help the administrator, meaning the department, to assess the income properly, and such that assessing officer can spend little more time on the productive areas and not on the routine items. However, one has to understand briefly that the primary responsibility of preparing tax audit report is of the SSE, and the responsibility of auditor is to only verify and report upon that. Now, while I'm on responsibility on reporting, let me briefly touch upon the reports and the Form 3CD. So when it comes to report, we will be doing reports in either Form 3CA or 3CB. 3CA relates to the entities which are already subject to some audit under some specific statute. 3CB are the SSEs where there is no other audit conducted. While we are on 3CA, one issue which can come is assuming, or generally in general, we understand that normally in case of corporate entities, there will be Form 3CA. Now there can be a situation where even on corporate entities, there may a need arise to issue Form 3CB. Now there are two such instances which apparently I can think that there can be Form 3CB instead of Form 3CA. One, if the SSE is following different calendar year or financial year as compared to the April to March period. So yes, if that is the case, then for March period, you may not, you will not have an access to a statutory audit report which will certify true and fairness, and hence there could be a scenario where Form 3CB will be applicable. Another such scenario where Form 3CB can be applicable in case of a corporate entity is a situation even if the company is following April to March as their financial year. However, for some specific reasons, the company has not been able to complete the statutory audit before the due date of tax audit report filing. In such cases also, Form 3CB would be applicable and not Form 3CA. With this background, Form 3CA generally will not certify true and fairness, whereas Form 3CB, there it is divided into two parts. One about certification of true and fairness, and then the factual statement about Form 3CD. So this means that Form 3CD is basically more or less a factual statement, and the information given in Form 3CD would be in the nature of true and correct, whereas in Form 3CA, 3CB, it will be true and fair if the whole audit is done. So yes, this is the brief background on scope and objectivity and the deliverables which one would issue after the completion of audit. Now, how is this applicable and to whom is this applicable? Would not spend much time on this as we discussed that we had been doing this day in, day out, but just to quickly brush upon, this is applicable for the turnover exceeding 1 crore. This limit has been extended to 10 crores in case the SSE is not having cash transactions, gross receipts and gross payments more than 5% of the total receipts and total payments. Quickly, gross cash transactions will also include bearer transactions, and in terms of total receipts and payments, contrast type of transactions will not be included. However, all the nature of transaction, even in the capital nature, will be considered for this calculation purpose. This is one primary condition for audit applicability. Second, if you are a professional, then your gross asset has to exceed 50 lakhs. Third, if you are not willing to opt under section 44 AD, or maybe not willing to offer income as required under section 44 AD, then in that case, you are subject to get your books of accounts audited. In case you are not willing to opt or offer your income under section 44 ADA, AEBB, BBB, so on and so forth, then in such case, you are subject to tax audit. Now, exception is that while we discussed 1 crore, there is an exception of 2 crores by way of 44 AD. It says that those who opt for presumptive taxation, the limit, it is only applicable if your turnover is less than 2 crores, and you cannot opt for presumptive if your turnover is more than 2 crores. Now, while we are on this 44 AD, let me spend few minutes on 44 AD because there could be some complications in understanding as far as 44 AD is concerned. Yogesh, can we check? There is some person who is distracting the screen. Somebody is scratching on the screen.
Let us check. Yeah.
So this was just a small flow chart in terms of giving the illustration that and who will be under which scenarios the audit is applicable, which we already discussed during earlier slide. Just wanted to share few examples or few transactions in case of 44 AD. Or few important points while we are looking at 44 AD. Now, one has to briefly everyone understand that if somebody has already opted for 44 AD, and if the person is opting out of that 44 AD within the period of block of 5 years, then that person has to get their books of accounts audited always, and there is no exception or no possibility to opt in under section 44 AD or a presumptive taxation scheme for next 5 years. So under such scenario, I just wanted to highlight few things, few important areas. The way section says that if you had opted out, then you cannot re-enter. So one has to be very careful while deciding, while one has to re-enter into this 44 AD regime, that if you have opted out, then you cannot re-enter. But for some reason, on a particular assessment year, if you become an ineligible, or if you are not an eligible assessee, then that period of 5-year block it will not tantamount to opting out. For example, so assuming if in an assessment year 21-22, I had opted for 44 AD. Now come to assessment year 21-22, my turnover exceeds 2 crore. In such scenario, what happens is that I become an ineligible assessee for financial year 21-22 to opt myself or to select the section 44 AD presumptive taxation. So what would this mean? Does that mean that this will tantamount to an opt out, and now for next 5 years I cannot opt in 44 AD? The answer is no. Here you are crossing the threshold, or you are becoming an ineligible assessee. So any change due to ineligibility will not tantamount to opt out. It will be an ineligible assessee, and your period or a block of 5 years does not get impacted. So this is one such differentiation or segregation which I wanted to make between opting out and becoming an ineligible assessee. So one has to be careful there. Now, if you read this example, it is exactly going to explain what I had explained in the talk a couple of minutes back during this discussion. So I'm not reading in the examples specifically, but the concept here, what I wanted to explain was opting out versus ineligible. Now, other important thing which I realized out of this typical 44 AD section is, what happens is, if you are on 44 AD, you have no choice and your turnover is below 2 crores, you have no choice but to offer your taxable income at 6 or 8% depending on your cash receipts or payments. However, assuming a scenario where you have crossed the turnover of 2 crores and you don't become eligible, in such cases, even if you don't declare 6 or 8%, you may, which is okay. So by this, what happens is small SSEs who are below 2 crores, gets indirectly penalized to offer 6 or 8%, but SSEs with higher turnover can still escape. So I don't understand why this anomaly between different threshold limit, but yes, this is something which I observed, and because of which small SSEs, there's a possibility that small SSEs may land up paying more taxes if they opt for 44AD. Otherwise, they'll have to get their books of accounts audited. This was one such exception. We did discuss opt-out versus ineligible. So yeah, this was broadly on section 44AD. In case if somebody has got any specific question on 44AD, then probably we can spend time on this topic, because this is one of the very important para or important item to decide whether there is a tax audit applicable or not. So let me pause for a few seconds here. So I don't see specific questions as of now in the chat box. One second. Okay. So one person having salary income and FNO loss of rupees 5 lakhs. So what is the question, Mr. Mahadev? How much is the salary income again? So let me cover briefly. What happens is, so in addition to the conditions what we've discussed, one has to see whether the total income is crossing the maximum income or maximum income which is chargeable to tax. So in that case, assuming if your ultimate income, total income, is less than the amount which is chargeable to tax, in such case there may not be any tax audit applicable. Otherwise, yes, it will be applicable, as I understand from your query. So yes, in a loss situation, there's a possibility that you will have a, say for your case, loss of 5 lakhs, and you have a salary of say 15 lakhs. So since your total income would be around more than 250, you are supposed to get the audit done. I hope your query is answered.
There are more queries.
Yeah, I'm reviewing that only.
Okay.
So can we show less than 6% profit when turnover is less than 1 crore? No. As I said, one will have to see the conditions as far as 44AD is concerned. There is a possibility that you may still have to show 6% because your presumptive taxation limit is 2 crores. So irrespective of whether, even if you are below 1 crore, then you have to still see those conditions. So next query is, sir, if opt for 44AD in AY21 and I have not opted for 44AD, which is AY22, I understand, and other income and offer income more than 8%. In that case, also tax audit required or not? So opt for 44AD in AY21-22, okay. And now I have not opt for section 44AD and offer income more than 8%. No, so if you're offering income more than 8%, then you're not subject to do any audit. But let me just share one more thing when it comes to 44AD and the percentage which we talk of 6% or 8% of taxing offering as an income. These are minimum income prescribed. Huh? So one has to make sure that if you are having more income, then technically more such income has to be offered for tax. Now, typically, one may argue that I don't have maintained the books of accounts, and how would somebody know that whether I have more income than 6 or 8% which is offered? One has to be very careful while doing this. I can share one example where we had come across one situation is an SSE was offering 6 or 8%, say in year one. Suddenly in year two, SSE bought a huge immovable property amounting to, say, example, 5 crore. Now, assessing officers came back and with those transactions, assessing officer came back and questioned that if you had not incomes which were not exceeding 6 or 8%, how did you buy this such huge property amounting to 5 crores? In that case, there are high chances that section 69 and all those may get triggered. So one has to be very careful while we are offering this income under presumptive taxation. 6%, 8% are minimum. Technically, as per section, any income exceeding 6 or 8% has to be offered a higher income and not only restrict to 6 or 8%. I go to the query of Govind Singh Purohit. If I have maintained books of accounts and my turnover is 35 lakhs and I am not opting for 4480, can I show loss and file the ITR without tax audit report? If you, as I discussed in my earlier query, if you have a loss and if your total income is less than maximum amount chargeable to tax, then probably no audit. But if yes, then yes, you will have to get the audit done. Can we not show profit less than 6%, 8%, maintain books of accounts and not file in section? No, you can't. You will have to get your books of accounts audited if you are showing less than 6 or 8%. In my query under section 4485, tax audit not required if I have not opted for. I understood that you have already opted for AY 21-22 and hence I replied that it would be applicable. Ashok Sharma opted for 4480. Now, even if the turnover is less than 1 crore, do not show 6% still tax audit will be required. Yes. Whether tax audit applicable if turnover below 1 crore? This is a repetitive question we did cover earlier. Books of accounts not maintained for loss in FNO turnover of 1.38 crore. Can he go to 4480 and claim loss without? Again, as I said, one has to see the net total income, and depending on that, the call will have to be taken whether 4480 or 44AB is applicable. So with this brief, I think we've broadly covered section 44AB, AD and applicability thereon. Let me jump on to the next slide. Again, this is a further example which is explaining under which scenario 4480 is applicable or not. Okay. Now, again, coming to very important aspect while deciding whether the audit is applicable or not. And one of the important aspect is turnover. Now, otherwise, this is not complicated. This is already listed and we have been using these criteria earlier. I would only like to touch upon few areas or few items which are of important aspect. One is the speculative transactions, futures and options. Now, these are three areas where one needs to be a little more careful as far as when you are determining the turnover. Speculative transactions and futures, one has to aggregate both positive or negative or favorable and unfavorable is which I wanted to highlight. Though there are some cases or some judicial pronouncement as far as futures and options is concerned that one has to consider, one need not consider the absolute amount, but only the net amount which one had made the profit or loss. But in my view, that may not be right. Even Institute is rightly saying in its guidance note that for futures and options, you have to consider the aggregation of favorable and unfavorable as far as turnover calculation is concerned. One important thing to understand or remember from options, even premium received will have to be considered for the purpose of turnover in case of option transactions. What will not be part of turnover? Quickly, routine items, but would like to spend a couple of minutes on this. One is as far as GST is concerned, the typical question arises whether GST will be forming part of turnover or not. The answer is yes and no, both. Yes, if one is following inclusive method of accounting and recording purchase and sales as gross. No, in case if somebody is following exclusive method of accounting. Another question is dividend and income from other sources. Dividend, what do you do? whether it will be considered as a part of turnover or not. So depending on the activities which you are carrying, so any activity or any dividend related to the business activity dealing into shares and transactions will be part of turnover, and accordingly even those has to be considered as far as the turnover calculation is concerned. One important aspect one need to understand is rent income. Whether rent income will be considered as a part of your turnover or no, depending, irrespective of whichever way you are showing this in your books of accounts. So if you refer the guidance note, it says that rent income will not be considered anytime as a part of turnover, because this income is always taxed as income from house property, and hence this should not be treated as turnover for the calculation of determining whether 44AB is applicable or not. And for all practical purpose, I myself I'm taking this view for many of my clients wherein they have huge rent income and no other business income. We are treating that as house property income and not considering that for a turnover. So the only twist here would be that there is a possibility that practically many times while we are entering into rent agreements, generally two different agreements are entered. One is for actual rent and one is for business conducting or a conducting agreement, wherein one shows that we are providing other facilities, say for example, regular cleaning or maintaining the premises or all those things. Now, if there is a receipt of such income, definitely that will be tantamount to business and turnover, but not what will not be part of business or turnover is the rent income, which is separately recorded. One issue which was prevailing earlier as far as partners' remuneration is concerned, so there was a view that partners' remuneration was considered as a part of turnover, and if it was crossing the threshold limit, then tax audit was applicable. But then now that issue has been settled, and even Institute in our latest guidance note, which is issued yesterday, has clarified that partners' remuneration and share of profit should not be considered as a part of your turnover, and hence it will not be applicable while deciding whether tax audit is applicable or no. So this was broadly on turnover when it comes to determining whether the tax audit is applicable or not. So any specific question here? Let me check. So before I jump on to this, there were two questions on 44 AD. Let me answer that. Profit above 6% or meaning if there is loss, that would also amount to less than 6%. So yes, definitely it will be amount to less than 6%. There was one question in case of partnership firm. So in case of partnership firm, 6 or 8% after salary to remuneration. Earlier it was after salary to remuneration, but there was some amendment couple of years back, and now it is before remuneration and not after remuneration. So I jump on to next. So yes, once it is decided and once we get on to the tax audit, what should be the responsibility of the tax auditor? Yes, tax auditor has to follow the principles of materiality, prudence, and substance over form. Very important thing one has to keep in mind is that in case if we have placed any reliances on any publications issued by ICAI, also any judicial pronouncements by various authorities, yes, definitely we have a right to do that. But at the same time, make sure that wherever we have done this, these are disclosed appropriately, either in the respective clauses reporting or maybe in your form 3CA, 3CD accordingly. So yes, we have a liberty to place reliance on various publications issued by ICAI. Typically at our office, what we are doing is, I'll just share while we are issuing the audit report, what we do in our audit report. So we do mention that yes, reliances have been placed on various publications issued by ICAI or any judicial pronouncements. This is what we mention in as far as our audit report is concerned. Additionally, wherever any specific reliances have been placed on the respective clauses, while we are taking the physical copies of Form 3CD, which is duly signed by the SSC and the auditor, we do mention against those respective clauses also. that yes, this is the view or this is the observation. So each clause will have different observations or views taken. The physical copies, I understand that there are limitations in terms of reporting those in online utility, but again, that we address by including a paragraph in our audit report saying that ultimate document for our tax audit should be considered as the signed copy and not the final utility, because final utility has some limitations in terms of giving some observations or disclosure. So even those we clarify while we are issuing the audit report. So this was one important thing. What if there are 2 or 3 businesses? Does the auditor prepare separate Form 3CD? The answer is no, it has to be one Form 3CD, because tax audit is actually qua SSC and not qua business, and hence one can combine one Form 3CD. However, for the sake of easy reference, what one can do is while reporting the data, SSC and auditor can make the necessary separate segregations, like assuming say related party transactions reporting. So you say entity A lists down the transactions, entity B lists down the transactions. So it becomes easy for future, and it becomes an easy reference available. So that is what we do as a practice, but definitely we issue one Form 3CD and not multiple Form 3CDs.
Yogesh, there are a few queries in the chat box. 2, 3 more.
Yeah. Firms having loss and turnover less than 1 crore is tax audit accredited? Yes, it is. Gross total income exceeds 50 lakhs with F&O loss of rupees 12,000. No books of accounts maintained. Can he claim loss under section 44 without tax audit? No, he cannot. Whether clause 44 is applicable to person who are not liable to get registered himself. We will come to that paragraph, clause 44. While we discuss this, I'll try to address at that time. So with this, let's move forward. Now, this was the brief background about tax audit. Now, let's go on clause by clause specific issues or concerns. Now, as I said, that tax audit is not new. However, what I have tried to do is I've tried to identify some unusual situations which I would have come across, that in such case, how do we do the reporting? Now, there is a possibility that I would not have been able to list all such unusual transactions. However, if there are anything specific identified by the team members, we can address, we can discuss those. So coming to clause 1, which is name, the typical question which can come arise is, what if the name has been changed after the balance sheet date, but before signing the balance sheet date or before signing the tax audit report? So what do you do? So my suggestion or view is that yes, you should take the new name, also mention formerly, and report accordingly. In case of proprietor, how do you report generally? So as I said, while tax audit is qua SSE, but we are actually auditing a business entity which or a concern. So in that case, the way I would report is, say, ABC Associates and Company, proprietor Yogesh Amal. That is how I would prefer to report in case of proprietary concern. In case of branch audit, yes, definitely the name of the branch has to be disclosed, and the fact has to come very apparently. Clause 2, address. Again, address change after the end of the financial year, but before signing the tax audit report, I would suggest mention both the addresses preferably. In case of company, also make sure that one is reporting even the registered office address if it is different than the admin office, where the which is generally communicated to the authorities for the taxation purpose. Okay. In terms of details of registrations under indirect tax law, typically, yes, generally one would obtain from the management that which are the various indirect tax law under which they are registered. The only point which I wanted to highlight here is that assuming a situation where you as an auditor come across a situation where the SSE was subject to take registration under a specific indirect law and has not taken such registration. In that case, what does one do? So my answer here is yes. If that being the case, we have to report that yes, SSC was subject to or supposed to take the registration under, say, example GST law, but the SSC has not taken. The reference here I'm drawing is from SA 250, which says that one, as a tax auditor, one has to also ensure that other laws and regulations which are applicable to the entity have been followed or not. And from there, I draw an analogy that yes, if something is not followed, well, we have to report. In case of status, otherwise it is very fair, simple. You just have to mention individual, firm, LLP, so on and so forth. However, there can be a situation in case of an individual which expires after the date of balance sheet date, or even maybe before the date of balance sheet date, and the return will be filed by the authorized representative or a legal heir. In that case, how should one address the situation? My answer is, in that case, one may not write individual. If that was an individual, in that case, one has to clearly clarify that the SSE is no more, and the audit or the return is going to be filed by authorized representative or a legal heir in his absence. Clause 8A, exercise of options. We are all aware that last 2 years there is a new tax regime, which there are new tax regimes under which the SSEs may opt at which section they want to, and according to the tax rate would change. The important issue here, or the concern here, could be that this opting of new tax regime has to be done before the income tax return. However, there is a high possibility that we as a tax auditor would complete tax audit much before the filing of tax return. And if the SSEs have not filed the forms during that time or by that time, in such case, what does one do? So the answer here is one has to either take the representation and also mention the fact that yes, based on the representation, SSE is willing to opt in say 115BA. However, form say 10IB is not filed. So these facts has to be addressed specifically. Typically, this clause will not be applicable generally in this year, because most of the entities who have already opted or exercised the option of various tax regimes in last year. But there is a possibility that somebody would not have done that last year, and this year is the year in which they may want to select this option. Hence, this is little relevant for this financial year also, or this assessment year also. Name of the members, partners in case of AOP firm, fairly simple, nothing much, except for just wanted to draw attention that in case of LLPs also, this information has to be given, because what happens is, in case of LLP, as far as income tax is concerned, they are at par with firm, and hence this information is to be given even for the LLP's SSE. Again, loss sharing ratio, if different from PSR, should be given. Remuneration changes should not be given. There can be a situation where somebody was a representative SSE or representative capacity as a partner, and he retires and now he becomes a full-fledged partner. What do you do in that case? So yes, one has to report these changes are changes, and those have to be reported as far as this specific clause is concerned. And all the changes which has happened during the year are reportable, and not the only change or the final change which is prevailing as on the closing date should be reported. Clause 10, nature of business, again, not a new clause. However, just wanted to highlight that any new line of activity has to be reported. Any extension of existing business will not be eligible or qualify for reporting under this paragraph. Important is to see various minutes and record whether there is a change in the line of business or no. Also, as far as corporate entity is concerned, segment reporting will help in identifying whether there are any changes or no. But in generally, again, a fairly old clause, nothing much to be discussed beyond this specific point. Details of books of accounts. Only one important point here to be considered is, what if the accounts are maintained online, or what if the accounts are on the portal or not sitting within the premises. So in that, or if the accounts are on the cloud, in that case, the fact has to come out that yes, accounts are maintained on the cloud. As far as guidance note is concerned, it is also requesting to share the IP on which this cloud-based accounts are maintained is what I wanted to understand. I wanted to make members understand. One important thing one has to understand is in terms of locations when we are giving, one has to ensure or give the address or location where there is a full-fledged or full set of books of accounts available. Now, there is an hypothetical possibility that SSC is having a sales depot, and to that sales depot, only sales transactions are visible, or only they have access to only sales transactions, and other full set of books are not visible or available there. In that case, whether that location becomes the location which needs to be reported for maintenance of books of account? The answer is no, because full access of books of accounts are not available there. Only limited access is there. Hence, only location where full access is available, those should be reported here. Method of accounting, yes, there is no change per se, but briefly once again wanted to touch is that there are only two methods of accounting which are prevailing, mercantile or cash. So any changes related to those only has to be reported here, and one should not get confused between any changes as far as accounting policies is concerned. For example, changing of accounting policy for valuation of inventory, whether that tantamounts to method of accounting or change in policy, the answer is one second. One second. Sorry. Sorry for this interruption. So what I was trying to say is any changes in accounting policy may it be of depreciation from say SLM to WDV or change in method of valuation of inventory, this all will qualify as change in accounting policy and not change in method of accounting. Hence, those would not be qualifying as a reporting requirement here, and only change where somebody is changing from cash to mercantile or otherwise will be reported under this paragraph. Closing stock. I would spend some time here when it comes to closing stock. Reporting for method of valuation of closing stock under this paragraph is only and only limited to closing stock. One need not comment about the opening stock valuation method. That is one thing one need to keep in mind. Though the terminology used here is closing stock, one has to make sure that closing stock is widely mentioned here or mentioned in a generic term. So all your accounting policies related to all your inventory valuations in line of AS2 has to be reported here. Important point to discuss now as far as section 145A reporting is concerned, inclusive method or exclusive method. While we understand what is inclusive method or exclusive method, briefly I would touch upon is in case of inclusive method, what happens is your purchases, sales, opening, closing stocks, you record in your books of accounts as far as inclusive method is concerned, which is including taxes, even though those are refundable. That is inclusive method. And it comes to exclusive method, you don't record those taxes in your profit loss account. Those are routed through balance sheet. Now, this is broadly inclusive or exclusive method. Now, as far as requirement of section 145A is concerned, vis-a-vis section, or rather vis-a-vis accounting standard AS2 is concerned. Now, AS2 does not allow that an SSC to follow an inclusive method. So what will happen for all practical purpose is that books of accounts are maintained based on exclusive method. Now, assuming that is the hurdle which has been crossed, that one has followed AS2 or accounting standard by following exclusive method. Now, when it comes to section 145A, if one reads minutely, it doesn't mandate or it doesn't warrant that you maintain books of accounts as far as your books is concerned from an inclusive method, meaning that you can still maintain your books of accounts as exclusive method, and what you do for taxation purpose or for section 145A purposes, that you prepare a reconciliation that had you maintained your books of accounts by following inclusive method, what would have been effect on your profit and loss, or how would your transactions of opening stock, closing stock, purchase, sale would have been seen. So again, 145 does not mandate that you maintain your books of accounts in far as inclusive method is concerned. It just says that you have to see, or you have to adjust your opening closing stock and your purchase sales. You have to make it gross, see whether there are any impacts on your profits, see whether there is increase of profit, decrease in profit, and accordingly offer for tax as far as this differences is concerned. Now, as far as institute is concerned, in all the earlier guidance or even in the new guidance, institute has been categorically taking a view, rather even I share the same view, that irrespective of method followed, inclusive or exclusively, there is no impact on the profit. And whichever way one maintains the books of account, my profit will remain the same. In generally, this statement will be true unless this is the first year of opting specific method or a change of method here. Meaning, until now, if you are following exclusive method and now you started following inclusive method as far as your books is concerned, definitely there will be some change, or vice versa. That is one point which I wanted to highlight. Now, coming back to the guidance from the institute, until what I observed today morning while I was reading through the new guidance note issued by the ICAI, until the old guidance note, there was a detailed example or reconciliation format given by ICAI, which explain how should one work upon when it comes to reporting. But with this new guidance note today, I observed that detailed reconciliation template or standard has not been given. They've omitted those disclosures. However, the view of maintaining that the profit would remain same has been continued. Again, a small observation here is, until last old guidance note, the impact, or as far as impact on the profit and loss is concerned, the terminology which was used by the institute was gross profit and net profit, both alternatively. But I observed in the current guidance note that they have refrained themselves to only say that there will not be any impact on the gross profit, which again in my view is right. But they have refrained themselves in clarifying that whether there will be impact on P&L or no, or on net profit or no. So this was one observation which I had while I was comparing two guidance notes. To summarize this, there is not going to be any impact irrespective of whichever method you follow. The only question which comes up in my mind was that until last year, what we were doing as a practice is that we used to make those reconciliations in terms of the formats which were given by the ICAI or through by way of guidance note. Now, the only point we need to address or answer is whether those formats have to be continued, or we merely comment that there is no impact under this section 145A para. So this was one important change which I wanted to highlight when it comes to closing stock, or maybe I would have wanted to spend a couple of more minutes because this being an important clause. So I will pause again for a few seconds here to see whether there are any specific questions on this clause being an important clause. So there are a couple of questions I would want to answer in case of one person having many proprietary concerns. As I said, one Form 3CD has to be reported. You may give the description, or you may give the disclosures separately for each entity to maintain the clarity, but one form is sufficient. One more question is, can a description of treatment of taxes as per books suffice, since there is no impact on profits for reporting the section 145, since there are different practices followed? Yes, as I rightly covered in my discussion just now, that even now I feel even I'll have to come back and decide whether you give those reconciliation statements to demonstrate that there is no impact on the profit and loss account, or whether the note should be sufficient in line of this change as far as guidance note is concerned. The question is, in case of many proprietor concern, whether balance sheet and P&L to be combined. The answer is no. The balance sheet and P&L should not be combined. However, reporting under Form 3CD can be combined. Balance sheet has to be independent, because those are different concerns. And more so from a perspective that there could be a possibility that out of say 4 businesses, say 3 would be part of 44 AD and 1 would be under say, sorry, 3 would be part of 44 AB and 1 would be under 44 AD, say presumptive taxation, which you may not do the audit. Hence, you will need those segregations as far as balance sheet is concerned. As far as ITR is concerned, I think you'll have to consolidate. You have no choice. So yes, this was on clause 14. Coming back to clause 15, not much reporting, not much reporting as far as new requirement is concerned. However, only point which I wanted to highlight or address here is that while we are recording all those transactions, one has to ensure that all the accounting standards are applicable while valuing those capital assets or stock in trade. So maybe in terms of capital asset, PPE has to be complied with, and in terms of stock in trade, AS2 has to be complied. That is what one should ensure. Since I am on accounting standard, just wanted to highlight one important thing is, now generally what happens is in case of non-corporate entities, there is a tendency to not follow the accounting standards. So hence, these are few clauses which are very important, and if those have been followed differently, one has to be very clear how are those calculations done and how are those reported. Coming back to non-compliance or non-following of accounting standards as far as non-corporate entities concerned, I'm sure all of us are aware that standards issued by institute are equally applicable to even non-corporate entities. But as I said, there is a tendency from few non-corporate entities that they don't want to follow the accounting standards. In such case, what do you do? So at our office, we have made a practice that in case if somebody is not following accounting standards, SSC may take that view, but as an auditor, which we are bound by ICI, we will have to definitely do the reporting, and we do qualify the tax audit reports if the accounting standards are not followed in case of non-corporate entity. So this was something which I wanted to highlight as far as paragraph 15 is concerned. Paragraph 16 is concerned, it is divided into 5 subclauses. I have not mentioned anything specifically on subclause A, but wanted to highlight one specific point when it comes to reporting of subclause A is concerned, which talks about receipts in the nature of business which get taxed under section 28. Now, one has to be very careful when in terms of reporting these situations where many a times the SSEs are receiving the benefits or perquisites in non-monetary terms. Example, a distributor or a retail or an SSE who is achieving say some threshold of turnover, and the company is giving them say free tour of say free outstation tour. Now, all those things generally, or companies giving some items or material in kind. Now, all those things generally were getting escaped as far as accounting is concerned, because those never came in the form of monetary transaction, and those generally or always got escaped out of the reporting and taxation also. But now with this section 194R, which is applicable in case of such transactions, and there will be TDS consequences as far as 194R is concerned. So one has to be very careful and make sure that any such transactions, 194R transactions, which are whether recorded or not in the books of accounts, and if not, one has to report those under section or under clause 16A is concerned. So this was one point which I wanted to highlight as far as 16A is concerned. When it comes to 16B, it talks of admitted by concerned authority. So one has to be very careful. Those claims which have to be reported only and only if those have been admitted by authorities. Merely claim lodging or merely claiming refund would not be eligible for reporting under this paragraph as far as clause B is concerned. Clause C talks about escalation claims. Again, the similar analogy which we discussed in clause B, that those escalation claims have to be actually admitted. Those have to be in the concrete shape that both the parties have agreed. Then only it will qualify for reporting. merely claiming or claims under negotiations or subjudications should not be eligible for reporting under this paragraph. There is a reporting requirement as far as clause 16D is concerned, that any other item or any other income. Now, does that mean that any other income which SSC has earned as far as reporting under or taxability is under income from other sources, typically in case of individuals, interest, dividends, so on and so forth? So the answer is no. Here, the broad expectation as far as this clause is concerned is that any other residual income which is not specifically covered under above clauses, and income in the nature of business source broadly, which will fall within the parameter of section 28 to section 44 and nothing beyond that. So this is on subclause 16D. Subclause 16E talks about capital receipts. So one has to be careful that which kind of capital receipts one will be reporting here. For example, capital contribution received in gift, share capital, etc. Or fixed deposits or other incomes, rentals, which are reduced from capital WIP is concerned. So one has to be mindful while one is reporting under this paragraph. Apparently, capital contribution, gifts, share capital, etc. will not be forming part of this reporting. The objective again here is broadly the receipts which would broadly fall in the parameter of section 28 to 44 will be eligible for this clause report. Coming to clause 17, transfer of land and building at lesser value than stamp duty value. Nothing new here, but only one important thing need to be kept in mind for this specific assessment year, which is financial year 21-22. Now, this was a partial year which was impacted by COVID, and that relief of 110% versus 120% in specific cases was there for partial year, which is up to 30th June 2021. So one has to be careful while reporting for such events during the year. As I said, this will be only and only applicable for financial year 21-22, nothing beyond that. Again, one has to be careful while you are reporting for section 43CA or section 50C, because definition of transfer under both this section is different. So before reporting, one has to carefully do the analysis of these sections and accordingly do the reporting. Now, typically, it can happen sometimes that the transaction is done, the agreement is entered, but it is not registered. Then what do you do in that case? In that case, one may take the opinion or one may take the certificate from some other expert that what is the ready reckoner or stamp duty value which needs to be reported as far as this paragraph is concerned. And again, the reliance is placed on section SS 620 using the work of other auditors expert. One has to be very clear when you are putting reliance on this SS 620. It has to be really an expert in terms of SS 620, and you cannot take this certificate or opinion from any ordinary person when it comes to your reporting is concerned. So hence the specific mention SS 620. One more typical situation can arise in case of an SSE who are builders and developers, now who are recording their revenues in terms of percentage completion. Now in that case, how does one reconcile reporting for this paragraph? Whether you have to do this reportings on year basis, you have to compare revenue recognized versus agreement value as far as each year is concerned, or you report these differences at the year or at the final year when you are actually transferring the immovable property or you are actually handing over the possession of the immovable property. The answer to this question from my side is that one has to look at the final year or last year when the actual possession has happened, and not look at year-on-year basis when the SSE is following a percentage completion method. So these were a few important points which I wanted to highlight in clause 17. There can be few typical situations as far as clause 17 is concerned: leasehold rights, development rights, TDR, FSI, etc. One has to identify whether these kind of transactions will be following within the broad definition of land and building or not, and accordingly view has to be taken. So each such transaction will depend on facts and circumstances, but one has to be mindful while reporting under this. There could be a situation where the value could be different on the date of agreement and date of allotment letter, or rather on the date of registration, which value one considers. So the answer to this would be on the date of agreement should be considered, and not the date of registration one should be looking at. Coming to clause 18, while there are not much changes as compared to last year again, but however, there are a few important transactions or points which I would want to highlight is one has to be very careful as far as adjustments of forex gain or loss is concerned in accordance with section 43A. Let me just briefly discuss that when it comes to adjustment or recording of forex gain or loss is concerned, as far as books is concerned, one charges this to P&L in accordance with AS2. But when it comes to block of assets, as far as IT is concerned, this is not allowed to be capitalized, or rather, at first place, this has to be capitalized. This is not allowed to be claiming as a deduction. However, this capitalization also is only subject to the loss or gain incurred at the time of making payment, meaning any revaluation gain or loss will not be allowed for capitalization as far as IT block is concerned. So in that case, what happens is one has to maintain the reconciliation of forex gain or loss recorded in the books between translation and transaction. When I say transaction, meaning gain or loss actually incurred at the time of making payment, and translation I mean is revaluation. One has to maintain the various reconciliations and accordingly make the adjustments when it comes to fixed asset block is concerned for forex gain or loss. One has to be careful if something has happened or there is a dispute in terms of written down value or allowability of depreciation in earlier years, in earlier assessments. So one has to be careful on those adjustments also. And if those adjustments have been agreed by the assessees, you have to recompute your opening WTV and accordingly calculate the depreciation. If those have not been agreed by the assessees and those are still in litigation, the fact has to be mentioned there. The question, another typical question which can come arise is in terms of books of in terms of claiming of depreciation. The assessee is claiming the depreciation in books but doesn't want to claim the depreciation in IT. Is it possible or not? The answer is no. It is mandatory and one has to claim. And if assessee is not claimed, then the disclosure should be made in Form 3CD or 3CB accordingly. Typical question arises in case of asset put to use date. How should one satisfy himself about put to use date? Technically, we should obtain the technical certificate from the management wherever required. However, very typical situation generally arises is in terms of reporting. There are two columns: date of additions and date of put to use. Typically, I have seen that generally date of put to use and date of additions always are same. In my view, that is not the right approach. Now, there could be a high possibility in case of an entities who are constructing a big project and there is a huge addition to fixed assets and which has taken a longer period of time. Now, example that somebody would have added the asset this year under CIVIP and capitalized in next year. In such cases, how does one respond to whether the actual date of addition will be required as far as reporting is concerned when the asset is put to use? The technical answer is yes. However, it will not be practically possible sometimes to give such a huge list. So what we do in that case is, if the SSEs are following as far as CIVIP accounting method is concerned, then we give one line of addition put to use, give one date put to use, and for date of addition, we give a note below explaining that yes, this is the asset which is capitalized out of CIVIP, and this CIVIP has been built over the years and which has got multiple date of additions, and hence there is no date of addition given. So those kind of disclosures one has to ensure, or wherever any specific view has been taken, one has to ensure that those disclosures are given. Another important thing, of course, which was relevant for last year, that if somebody had a goodwill in their block of assets, those had to be removed from their block of assets in previous year. Additionally, there were few more adjustments which were required as far as opting of new tax regime is concerned when this fixed asset clause. So any additional depreciation claimed earlier, and the new tax regime was opted for the lower tax regime. So then there was an adjustment required under section 115. Again, those was an history. It was applicable only for last year typically. However, this can only apply during the year in cases where somebody has opted this year and not in the earlier year. So one has to be careful even for those adjustments. So this was broadly on clause 18. Clause 20, employee benefits, would not spend much time except to highlight only 2 points, that if you come across a situation where PF or ESIC was say applicable and SSE has not taken the registration, whether you report such instances or no. So the answer is yes, one should report such instances, because again, I draw a reference from SA 250, wherein the other laws and regulations were applicable and SSE has not followed. So that has to be reporting done. That is one point which I would want to highlight. In terms of employees' contribution, of course, there was a lot of debate until last year that whether employees' contribution paid after the due date of respective act, but before filing of income tax return due date, whether those will be eligible or allowable or not. So the view was taken that yes, it was allowable and people were claiming those depreciation, but that controversy has now been settled and the sections have been amended, that no such benefit will be available and those will be disallowed if those are not, or rather if those are paid beyond the due date. One typical point, which again will be only relevant to this financial year, I would want to highlight, and I've come across such situation, is I think in April and May, PF and ESIC Act had given some relaxation in terms of making the payment late, wherein they had said that they will not levy the interest. Now, based on the reading of those circulars by PF authority or ESIC authority, what I had observed was they have not extended the deadlines. The due date still remains the same, say example 15th of May for April. However, they have only given the benefit to the SSEs that they can pay late and interest will not be levied. Now, assuming in such scenario, for April contribution, somebody has contributed on 20th May, while PF authority is allowed to do so without charging any interest. But as far as IT is concerned, I have taken a view, or rather in my view, it would still be disallowed because the due date had not been extended under the respective act. So one has to be mindful while you are reporting in this paragraph for this specific period where there was an extension for payment without interest as far as PF-ESIC is concerned. So let me take a pause for a minute here and see whether there are any specific questions. So stock quantity disclosure is mandatory, especially when electronic and small items. I believe you are talking about quantitative details paragraph. And if that being the case, no, it is not mandatory for all the items. It only talks of disclosure in terms of principal item is concerned. So this was the answer to Ankit Parmar's query. And Mr. Aditya Maheshwari, notice have come for reporting other income in 16D last year. How to reply? Income being added in business income. Income being added in business income. So if this was a transaction of last year and if it was added also in last year, probably the answer would be that I would not report under this paragraph because this is broadly talking for current year, Mr. Aditya. Mr. Mukesh, whether bad debts can be claimed separately in case of income offered under presumptive method of AD or ADA, the answer is no, you cannot claim it separately. Khushbu Shah, in case of clause 17, if SSE being a purchaser where stamp duty value is more, is it to mention? No, it is, I think, talking of full value consideration for the sale purpose, and hence it is not required. Dharachand Jain, sale of residential premises, date of agreement 31st March 22 and date of registration 12th April 22. In such case, when the sale should be recognized? Typically, one will have to say when is the effective control transferred, and one will have to go to that level to decide when should one record the sale. But apparently, looking at the facts, I understand most of the conditions which are required were complied by 31st March. And assuming if merely registration, which was a procedural aspect, which was done on 12th April, in that case, I would recognize on 31st March and not 12th April. Last year, meaning FY 2021, notice came under section 143 for addition of income tax on the head. Yeah, so I appreciate what you mentioned, that, as I said, since it is belonging to earlier year, you will have to report, you will have to refrain in reporting and not do this in reporting here. Start from clause 44. So is employee contribution to PF done after due date to the reported, or only employer contribution? Under this paragraph, it is only employee contribution and not employer contribution when it comes to clause 20 is concerned. So let me jump on to next clauses quickly. I'll try to discuss quickly because those would not be very detailed clauses. But however, I would like to spend a little more time in terms of clause 44 is concerned. So hence, now on that, trying to take a little faster. Interrupt me wherever you feel that you need a little more explanation on those clauses. Clause 21, this is broadly about reporting on for fines and penalties quickly. There was some amendment which was done in section 37 where the coverage was increased now. So while reporting under this paragraph, one has to be very careful. One quick point which came in my mind while reporting under this paragraph is concerned. So broadly, if one has to read this clause, what it says is, or rather what section 37, one relevant to this clause says is that any expenditure incurred which is in violation of any law should be getting disallowed. So one quick question, or one which comes up in my mind, is typically in case of pharma industries, we know that they incur a lot of sales or business promotion expenses to the doctors. Now, technically, as far as medical council is concerned, it says that doctors should not take those kind of perquisites or benefits or facilities which has been given by pharma company, which will be illegal on the part of doctors. However, what happens is there can be a discussion point wherein so whether these kind of transactions will be a transaction which are a violation of any specific law or not, one has to do the careful analysis in the case of pharma industries. I have also seen pharma industries representing that this kind of expenditures will not be falling under those parameters of expenses which are in line with violation of any law, because what they claim is this MCI or medical council laws are not applicable to the companies, and what expenses companies incurring is purely from the perspective of doing business, and hence these kind of expenses should not qualify for these reportings. But one has to be very careful while if you have come across this situation, you'd have to well document it properly, that why have you taken a view that this is not reportable under this paragraph, because there is a high possibility that you may take a view that these are expenditure incurred for something which is not in accordance with the law, and hence this will be disallowed. This was one important thing which I wanted to discuss under this paragraph. Other important thing is the possibility that sometimes we pay TDS on somebody's behalf, which is on other suppliers, meaning we bear that expenses, whether those expenses are allowable or not under, or whether they are reportable under this clause or no. The answer is those expenses are allowable. However, one has to be careful while claiming those expenses. That you have done a proper grossing up, meaning 100 rupees ka expenses hai, 10 rupees TDS bhar ke debit kar diya. So there could be a question arising for disallowance of section 40A(1)(a) on account of short deduction. But ideally, what you should have otherwise done is 110 का खर्चा समझ के 111 रुपया TDS पे करना चाहिए था. So that is what one has to keep in mind when it comes to TDS is concerned. TDS late interest, or rather interest paid on depositing TDS late, whether that will be allowed expenditure. My view is yes, it will be allowed as a deduction. This was broadly on 21, 23, nothing much. It is just that interest will be disallowed if any provision is made, or irrespective of that, whether provision is made or not, it will be still be disallowed as far as section 23, clause 23 is concerned, clause 22 is concerned. One quick question here which can arise in case of non-corporate entity is what happens in case of a situation, or rather even for that matter corporate entities. What if there was a liability of making interest payment and the SSCs have not provided? What do you do in that situation? Allowability, the secondary aspect, but what do you do if the liability is not provided? So depending on the materiality, I would take a view. If there is no provision made, there could be a chances that one may qualify the audit report that accounts are not true and fair. Why am I taking this view? Is MSME Act is overriding, and it is saying that irrespective of whatever mentioned in any of the act, you have to pay to MSME within 15 days, and you cannot delay the payment beyond 15 days. And if those are delayed, then definitely there has to be an interest payment. Payment to related party, whether it is covering only revenue expenses or capital. So answer is capital also. Disallowance section 43B. Okay, one typical question when it comes to disallowance as a 43B is concerned. Now there is a possibility, since the assessee is allowed to make the payment until the due date of filing, there is a possibility that you would have filed the tax audit report before the due date of filing tax return, and there would be some amount which would not have been paid. So what do you do in that case? In that case, one has to report that these reportings are up to this date, and SSEs then in turn claim these benefits in ITR. But typically what I have seen last year is AOs have been requesting to revise the tax audit report, and there is a procedure to that. They have been requesting tax auditors to revise the report and to include or to disclose even the payments which are made after the tax audit report, but before filing income tax return. So the word of caution which I want to make here is that while you are doing this revision of tax audit, please make sure that necessary compliances as far as revision is concerned has been taken care of when it comes to ICI, because ICI has a detailed guidance in case of situations when can one revise the audit report. So that has to be kept in mind. Reporting under para 27A, central value added taxes, so on and so forth. One quick question here is whether GST needs a reporting under this paragraph or no. The answer is no. My view is that answer is no. It should not be reported, because when you read this requirement and also when you read the guidance note, it typically only talks about the SENVAT transactions, and there are separate SENVAT rules which governs the SENVAT transactions. GST is not covered under those rules, and hence in my view, for reporting under this paragraph, GST should not be considered. However, I have seen both views are prevalent. There are auditors who are reporting under this paragraph also. But as I said, I would refrain myself in reporting and would not do the reporting. Coming to prior period items, just one quick mention. Prior period item. Now there could be a situation where company auditor or a corporate auditor would not have reported in its statutory audit report as prior period item or in the financials. Now, assuming you are the auditor who is there doing only tax audit and not statutory audit. Now, in that case, do you keep reliance on the statutory audit and don't dig into the prior period item? The answer is no. As a tax auditor, you have an independent responsibility of ensuring all the reporting requirements when it comes to Form 3CD is concerned are done properly, irrespective of whether the statutory auditors have done those reportings or not. Hence, this would be equally applicable. So assuming if there are some private items which you have identified as a tax auditor, those will qualify as a reporting, irrespective of whether statutory auditors have reported or not. Issue of shares, not new, just wanted to highlight that one should keep in mind 11 UL valuation while you are considering reporting under this paragraph. And in case if the companies have issued shares at a higher value, then the FMV, the difference will be taxable under income from other sources. Forfeiture of money received as advance or otherwise in the course of transfer of capital. Okay. One quick point to highlight under this paragraph is this forfeiture event actually has to trigger. Now, meaning so that merely book entry or not a book entry would not tantamount whether you have really forfeited or no. So one has to see the detailed facts and circumstances before reporting under the. Apparently, as I said, just because somebody is passed an accounting entry or just because somebody is not passed an accounting entry for forfeiture, that may not warrant the reporting under this clause. One has to go beyond that and identify the facts and circumstances and decide whether reporting is required or no. Important question which can arise is reporting is to be done for which year, or rather in which year. So it has to be done in the year of forfeiture, irrespective of whichever year money is received. Another important thing, there could be an agreement where actually those conditions would have been breached and the SSE is eligible to forfeit that amount, but SSE has not done that. What do you do in those cases? So as I said, one has to look at the little more detailed facts and circumstances and then decide whether reporting is done or reporting is to be done in this paragraph or no. So the immediate question which can come in my mind is, if the event has triggered, then why has the SSE not done that? One need to discuss that and accordingly take the view. Transfer pricing adjustment, yes, primary adjustments, if any, has to be reported under this paragraph. Typical situation can arise is a transfer price, this primary adjustment would have been done by the AO during the year for some earlier period. Whether even those would be reported, so yes, any transfer pricing or primary transfer pricing adjustment done during the year for any of the period by any of the concerned person will qualify or will be eligible for reporting under this paragraph. Thin capitalization, I'm sure all of us are aware, which talks about interest paid to associated entities, associated enterprises more than 1 crore. There is some calculation behind that. The only question which I wanted to highlight here is, or what I wanted to discuss here is, assuming if there are 4 entities, 4 associated entities, and to each of the entities you have paid 50 lakh, 50 lakh. So whether this reporting is per SAE or cumulatively 1 crore limit has to be seen. The answer is you have to see cumulatively 1 crore, you have to see in aggregate, and you cannot see or you should not see AE wise. Okay, one new reporting requirement which starts from this year along with clause 44 is clause 30C, which is in accordance, which is in connection with GAR. Apparently, the provisions that when would this apply, how would this triggers are very complex. One need to be very careful while you are reporting this. However, one word of caution is I am practically not sure how would this reporting get started. When we say that the responsibility of making this form 3CD is of SSE. Now, I am not sure whether any OCC will stand up and say that I have done these kind of adjustment and they would start reporting under this paragraph. So this would be really complex exercise to report under this. But yes, this has been implemented from this year onwards, and one will have to be careful or mindful while reporting under this paragraph. Coming to clause 31, which talks about loans and deposit accepts and paid, which generally we understand as section 269 SS or T. Nothing new. Just wanted to draw or wanted to highlight that under this clause, ensure that, or rather, as far as security deposits is concerned, even those are covered. So I have seen many auditors who are actually not covering security or trade deposits in the nature of loans and deposits. See, the clause talks of loans and deposits both and not only loans. Hence, one has to be mindful while reporting under this paragraph that normal trade security deposits also will be getting covered for reporting under this paragraph. One has to be mindful while reporting under this paragraph for the transactions under made through journal entries. I have seen one typical situation wherein loan was converted into equity by way of journal entries. Assessing officers have come back and said that no, this is not in accordance with section 269T and there can be a levy of penalty. At our office, as a practice, what we are doing is wherever we find any such entries, we do report it properly in terms of saying that these were the transactions which are otherwise done by an account pay check, or otherwise done by an account, or otherwise done by transactions which are specified in clause 31. So one has to be mindful there. One typical or one typical or general issue then comes up in loans where interest is routed through loan account and then it is paid. Now the question can come arise is whether the interest credit in that loan account and then paid will be eligible for reporting under section 269C or S or T or not. The view what we had taken is if the interest is credited and paid immediately, we should refrain in reporting those transactions. However, assuming if there is only a credit as far as loan account is concerned on account of interest and it is not paid, and this becomes an opening balance for next year's loan and interest is also paid on these balances, then you have to consider those as loan received or deposit received and report under section 269 SS. Practically what we do or what we suggest to our clients is that try and park this interest payable in separate ledger and pay through that ledger and don't route it through loan ledgers to avoid the complications. So this is what we take care as far as clause 31 of reporting is concerned. Clause 32, brought forward losses, only word of caution that if there are any litigation for the earlier years, one has to be careful and make sure that those litigations, due to those litigations, any losses increase or decrease should be reported accordingly and correctly. TDS, again old clause, but just wanted to highlight a couple of things when it comes to TDS clause is concerned. Two important sections during the year one need to be careful in mind is section 194Q vis-a-vis section 267 TCS 206C. So as you all understand, generally the primary responsibility is of deductor first, meaning TDS should be first and TCS to follow. However, if somebody is not done TDS, TCS, the other person has done the TCS, how do you report those situations when it's come to compliance of 194Q is concerned? So one has to be careful there. Apparently, I have taken a view that if 194Q is not done, if it was supposed to be done, and there is a compliance as far as 206C is concerned, then probably since the compliances have been done, the objective of this section was to track the transactions and which has been done either via 194Q or 206C. I may refrain in terms of reporting these non-compliances of 194Q. So this was something which I wanted to highlight. Also wanted to highlight the applicability of 194R now, that there is a possibility that you would have deducted TDS under section 194R. So those have to be reported properly under this schedule. Inventory, nothing much to discuss. Deemed dividend, we are used to. Only thing is there are few exceptions when it comes to calculation of deemed dividend is concerned, that any advances in the ordinary course of business should not be considered for the purpose of calculating deemed dividends. There are few exceptions in terms of accumulated profits. There are few discussions that what should be accumulated profit, capital profits, part of the accumulated profit or not. Those has to be taken care of before deciding the reporting under this paragraph. Only practical situation which can arise while reporting under this paragraph is that deemed dividend is taxable on the date of transaction. Now there is a possibility that transaction would have happened in the mid of the year, and during that period or on that date, the financials are not drawn. So one may find it difficult to identify what is the accumulated profit as on that date. Hence, one has to document it properly while reporting under this paragraph, that how has one computed accumulated profit, whether that is right, wrong, or not. This is something which I wanted to highlight when it comes to deemed dividend. Okay, finally, before I jump on to clause 44, one more important paragraph which I wanted to highlight was clause 42 when it comes to reporting of section 42 is concerned, and it comes to reporting of SFT. Now, when it comes to SFT, there are high chances that now even dividend paid was covered as a part of SFT reporting. So there are high chances that SSEs would have forgotten to include those dividend reportings, because typically the moment you say SFT reporting, there are few things which are registered in the mind of people. SFT में तो खाली शेयर इशू आता है, कैश के ट्रांजैक्शंस आते हैं, म्यूचुअल फंड्स के ट्रांजैक्शंस आते हैं, एफडीज के ट्रांजैक्शंस एंड सो एंड सो फोर्थ. But dividend generally get escaped, so one has to be careful while you are doing those reporting as far as SFT is concerned. And if you come across a situation where there was an SFT reporting required, but SSE has not done, then reporting has to be done that yes, there was a transaction which was reportable and the SSE has not reported when it comes to clause 42 is concerned. So I have otherwise covered most of the clauses. Now I would want to jump on to clause 44. But before I jump on to clause 44, let me see the questions, if there are, which needs to be answered. So recently judgment came disallowing interest on late payment of TDS from Delhi ITAD. Yes, I am aware of that judgment, but as I said, it is just an ITAD decision, and I would still continue with the view that this is not in the nature of penalty, it is in the nature of compensation, and hence there should not be any disallowances on these items. Can someone remove the scratches? Okay. For reporting under clause 30C, is reporting responsibility limited to arrangements to avoid tax as identified as principal commissioner or approving panel as stated one second. Sorry. So for reporting under clause 30C, is reporting responsibility limited to arrangements to avoid tax as identified by the principal commissioner or the approving panel, as in guidance, or tax authority need to perform procedures independently? Now, apparently my view is yes, tax auditors need to perform independently, but practically, as I said during my discussion, that I'm really not sure how would one do that, because the basic premise of this reporting would be that one should be able to identify. Now, if somebody's really done this, they would have routed the transactions with so many multiple. I'm just giving an example that there could be a transaction from A to B, B to C, C to D, so on and so forth. And you, as a tax auditor, may not be an auditor for all those four entities. Consequently, you may not be privy to all this information, which makes life a little more difficult. And hence, I am not sure how would it be really easy to identify or detect that these kind of transactions have happened. But as far as responsibility is concerned, in my view, yes, tax auditor needs to perform procedures independently to identify whether any such transactions have happened or not. Salary and other expenses paid through JV, no, it would not be forming part of 269 SST because those are not loans or deposits. Sir, what happens if promoter has paid from his personal account to vendor on behalf of company's reimbursement? Okay, so typically, again, the recording would decide what happens to this kind of transaction. So assuming if this was a pure reimbursement, then definitely you are not going to record these transactions in your loan account, and you would show these amounts as separately receivable and payable. Hence, if that being the case, then it will not be applicable. And that is what the practical solution or request which we have been maintaining in talking to our client, that any such transactions should not be routed through loan accounts. And if those are in the nature of reimbursement, park it in separate ledger called, say, other receivables or other payables, and route it through those transactions. But while we are saying this, we need to ensure that we don't make this as a practice, or SSE doesn't make this as a practice, that even routine transaction in the nature of loans are routed through such account. If that being the case, then there could be a difficulty. But apparently, reimbursement would not be getting covered in 269 SS and 269 ST. Viren Soni. Yeah, practically, as I said, it is difficult to identify such arrangements. Ankit Parmar to everyone. This salary and expenses are capitalized to loan account in the end. Okay, so if these are the expenses which are capitalized to loan account in the end, and as I said in my talk earlier, that if these are capitalized to loan account and next year onwards, these will be eligible for interest as your loan balances, then definitely these are transactions in violation of an SST through JV, and I would report those transactions as transactions in the journal format and not as required by the section. So now jumping to clause 44, which is the talk of the town for all of us as a professional, that how does one really does the reporting and what are the kind of reporting requirements when it comes to clause 44 is concerned. Okay, so I am not debating or discussing on an issue that whether this clause is applicable for financial year 21-22 or not. I think now it is more or less a settled situation that this is applicable for financial year 21-22. This was equally applicable to clause 30C as we discussed earlier. So now there is a situation that yes, this clause is applicable. What is the reporting requirement as far as this clause is applicable, as far as this clause is concerned? So broadly, there are 7 columns under this clause, which starts with talking that first column, total amount of expenditure. Then there are 4 columns which talks about expenditure in respect of entities registered under GST. And there is 1 column which talks about expenditure in connection with registered and non-GST. Within the transactions for registered under GST, there are 4 columns. 1, expenditure related to goods or services which are exempt from services, composition scheme, other registered entity, and total. So these are the broad reporting requirement when it comes to clause 44. Just quickly, 1 second, let me open the actual clause 44. So I'm sure you are able to see clause 44 PDF file, which is part of guidance. Deshwa, if you can just confirm.
Yes, we are able to see clause 44.
Okay. So as I discussed, there are 7 columns, serial numbers, and these 3 columns. Other than this, there is no specific guidance or there is no specific discussion when it comes to various terminology which are used. For example, expenditure. Now the question can arise is, what do you mean by expenditure? Revenue expenditure, capital expenditure, or expenditure which is only forming part of P&L or not. So this is the one apparent or preliminary question which comes up in my mind. Clause 2 or column 2 asks for total amount of expenditure incurred during the year. Now, again, the question can come here is, when it talks of total expenditure, whether we give the disclosures line by line under this paragraph, such as, for example, purchases X amount, repairs and maintenance Y amount, so on and so forth, or we give the consolidated amount as far as reporting under this paragraph is concerned. Now, when we come to other issues a little later, but first I thought let me brief my view in terms of these 2 first preliminary questions. As I said, first question is whether it talks about revenue and capital both, or revenue or capital, so on and so forth. So answer to this question is, my answer to this question is, we should include both revenue and capital. The coverage of this process.
Sorry, Yogesh, sorry to interrupt. We are able to see the slide, not the PDF.
Yeah. Now I'm on slide. Sorry, now I'm on slide.
Okay, because the participants were writing, they're not able to see the PDF.
And
Yogesh bhai.
Yogesh bhai,
Yes.
Usually there are certain spreadsheets on the screen, what we are running. So basically, if you just can just stop the screen sharing, and again, if
I
you
would
can
do
see
that. I
certain
would do that.
spreadsheets are there.
Yeah, I would do that. Allow me a second. Let me know if the screen is visible now.
Yes.
Yeah, it's perfect now.
So the question which arises here is, as I said first, whether it is applicable to what kind of expenditure, whether it is only revenue or capital. The answer to this question is it is applicable to all expenditure, and one should not refrain in restricting for reporting for revenue or capital or otherwise. That is first preliminary question which needs to be addressed. Now, second question is whether you give one amount or whether you give detailed expense-wise explanation. Again, my view here is, and of course, this is also supported by guidance note issued by ICI today, that you may give consolidated amount. However, one can segregate the disclosure in two parts: expenditure related to revenue, expenditure related to capital item. So this broad segregation one should make for these reportings, and it will not be only one line item, it will be two line items, say revenue and capital. However, while we are discussing further clauses, we will have to keep in mind that we are maintaining the detailed working of these expenditure or these amounts or these calculations. So yes, this is what was a response on second question. Now coming to the key, that I'm going back to this slide. So here we addressed that we will report revenue and then figures, capital and then figure. That is how we will report as far as this paragraph is concerned. Because what I have been made to understand that utility is allowing to enter data in multiple lines. However, it is not allowing to enter any description. So what we will have to ensure as in tax auditor is that while we take the signatures on the physical copies, we should make sure that we are writing the description properly there and obtain the copies accordingly. So this was on column 2 as far as reporting is concerned. Now I go back to my slide once again. Now question is, two buckets or two categories have now been created: transactions with the registered entities, transactions with the non-registered entity, and the total amount there. So apparently, how would I really work upon? Of course, while I'm saying this, it is definitely not easy. The major challenges which one would face is because the SSAs have not maintained the data, or probably they would not have maintained the data in such cases. Now I'll come back to that situation last. If that being the case, what do you do? But assuming that SSA has maintained some data, then how do you address this situation? So what I would do is, or rather the apparent question now comes in mind is, how do you really start to compile this data? So whether you really start with 2A, is that the starting point to compile this data, or whether you start with books of account? So answer to this question is, I will start with books of accounts, because when it comes to 2A, there could be many such transactions which I would not have recorded or accepted, or there could be many reconciliations items between my books and 2A. Hence, I would refrain as far as my starting point is concerned for this calculation, and I'll use my books of accounts. Now, the moment I have used my books of accounts for this purpose, typically I will list down all the transactions. I will say all the transactions which have been entered during the year, which are in connection with revenue or capital items, barring certain exceptions. Yes, let's not discuss that now first, but internally I would extract the books in such form that it gives me expenses incurred during the year vendor wise, and it also gives me GSTIN number besides that vendor name, so that for any further reportings, these two typical columns are going to help me. So as I said, I would extract that data. While I say this, definitely again, as this is not easy, one will not get this data easy. But as a reconciliation point, what will happen is, how would I start when it comes to calculation of expenditure for GST is concerned, typically all my purchases, all my expenses, all my capex, so on and so forth, will have to be identified, will have to be listed vendor wise. While I said that we will do this from books of accounts, however, my reporting will be for the transactions based on the invoices received. I will not report, or rather I will ignore for the transactions which are in the nature of allowances, in the nature of provisions, prepaid, so on and so forth. Meaning, assuming I have received an invoice for services which has got a prepaid element. So in my P&L, it will be say 50 rupees and 50 must be sitting in my balance sheet. But for reporting under this paragraph, I would not restrict myself to 50. I will consider whole 100 because that is the invoice which I have received. Similarly, in my P&L, there will be some provisions for which I would not have received the invoices. I will ignore those expenses. This is what I mean by prepaid expenditure ka adjustment I will do. I will make the adjustments of provision for expenses. I will also ignore depreciation for calculation of total expenditure. Meaning, why am I ignoring this? Is because this is not an expenditure, this is an allowance. Consequently, I will also ignore bad debts or other provisions for bad and doubtful debt or contingencies. Now, as I was explaining, all such expenses which are not in the nature of received or booked by way of invoices, I will ignore. So hence, this is how broadly I will try to capture the data or generate the data for my reporting of paragraph 3, 4, 5, 6, 7, 8. I'm still on column 2, that how do I generate or which are the items which I consider for the purpose of column 2. Assuming if there's an entity is following Ind AS, there could be further adjustments of notional interest by way of following Ind AS 109 or lease transactions 116, so on and so forth. So all such notionals or those kind of transactions have to be excluded, and then you derive one expense or one list which is getting eligible for column 2. Now, while I am preparing this list, I will include only those transactions which are in the nature of supplies as defined by the CGST Act. Meaning to say, example, salaries. Now, salaries are not in the nature of supply. So while I'm calculating this, I would probably ignore the salary to determine the amount to be reported under total expenditure. So again, as I said, I will prepare the list vendor wise, do all these adjustments and derive a number which is reportable under column 2. Again, to summarize, मैं सारे वही transactions लूंगा जिसका मुझे invoices आया है during the year, irrespective of how have I accounted in my books prepaid provisions. I'll have to ignore that. So this is the starting point as far as reporting of clause 42 is concerned. Now, once we have identified this list or prepared this list, now we start working on further columns. So one of the columns is expenditure related to exempt items. Now there, all nil related items or exempt items or non-taxable supplies, again, I'm saying non-taxable supplies, will be reported under these columns. So practically to work on this, what will I do? The list which I have compared for column 2, I will filter the vendors which are into providing the nature of services which are in the exempt nature, mark those, calculate those values, and accordingly report in column 3, which is for exempt services. Friends, trust me, while I'm speaking, it seems to be easy, but practically it will be really difficult because I'm not sure whether the SACs would have maintained the data in such format. So this is about column 3. Going to column 4, which is under composition. Again, as I said, that since my starting point was list vendor wise with GSTN number, I will again identify from that vendor list who are the vendors which are under the composition scheme. I will mark them and accordingly report those data. Go to the next column. So, okay, this will come a little later. Go to the next column, which will give me all the transactions, or rather vendors which has got GSTN and have transactions. I will report under column 5, which is all the transactions with the registered entities, and all the vendors who does not have GSTIN number will be classified under clause 7, which is URD. Now, while we are doing this, typical questions can arise is what happens to certain typical types of transactions. So in case of, say, for example, interest paid to bank, where will you qualify that? We will be exempt. Salaries, as we discussed, not a supply. Depreciation, as we not discussed, not a supply. One typical or unusual situation which can arise is RCM. Now, while on RCM, we have discharged the GST liability, but there are high possibilities that those expenses can get classified under both registered and URD, irrespective of whether we have discharged the ITC or GST liability or not. The purpose of this clause is to capture the reporting for transactions with the entities which are registered or unregistered under GST regime. So as I said, there is a high possibility that for in case of RCMs, somebody few vendors may get qualified as registered if they are registered, if not unregistered. Now this is one unusual with situation which can arise. Yeah, so this is how broadly I would work upon clause 44 for the reporting purpose. But as I said, it was not as easy as it looks like, but this is the only choice left. However, assuming if the data is not maintained by the SSE in the format in which it is required, I have given certain disclosure that this is how one has to be disclaiming. But while you are disclaiming this, one has to also make sure that there are some reporting requirement in GST form 99C. You have to be in sync with those. It should not happen that while you are disclosing, say for example, detailed breakup here in tax audit, and in GST we mentioned that no such data is maintained, or vice versa. So one has to be careful while reporting this. So with this background, this is what my analysis of clause 44 is, and this is what my way of working this clause 44 is. Now, while I say this, that we will use this data, now there are high possibilities that you may not get the data easily, or you would have taken certain assumptions while reporting or compiling this information. So one has to make sure that all such assumptions or all such views taken has to be appropriately disclosed while reporting under this paragraph. So with this brief discussion from my side, I take up the questions available in the chat box. So I start with first question. In case of builder, no ITC is taken, whether clause 44 is applicable. My view is yes, it is applicable, because here clause 44 doesn't talk about whether ITC is taken or not. Here they are expecting the transactions with registered and non-registered entities. Now there is a high possibility by doing this, it could be a possibility that SSE has done a transaction with registered entity, but those transactions would be under the nature of composition scheme. Now, there's a tendency that people don't register their GSTN numbers or registration numbers for those vendors. Now, while you have generated the report, there is a possibility that these transactions, though eligible for reporting under composition, may get reported under URD, because of non-availability of VAT or GST tin. So it is very important that the base data which one has to use is accurate. Otherwise, this is going to, this is going to lead to a chaos situation wherein reporting will be really haywire. URD numbers will be reported such huge in number. And as I understand, the objective behind introducing this clause is to capture the URD or to analyze the URD and take those people in GST net. That is what my apparent reading is. But unfortunately, the way reporting for this clause has been drafted, I don't see this objective or purpose is going to be served. So, but we have no choice but to report as it is. So complete exercise is required to make for reporting. Yes, please re-explain the treatment of prepaid expenses for clause 44. Okay. So what I'm trying to say here is prepaid expenses have to be excluded, meaning assuming if you have considered or if you've received an invoice of 100 rupees in your P&L, it will be only 50 and 50 must be sitting in your balance sheet as prepaid expenses. However, for reporting under this paragraph, I will consider 100 and not 50 is what I wanted to explain. How about section 43 be applied to expenses covered under this section? How section 43B be applied if expenses covered under this section are debited in capital work in progress? So as I said, irrespective of wherever you are recording, any invoices received in the nature of supply will have to be considered for this clause, irrespective of payment, not payment, 43B or not. So this, it is irrelevant as we discussed. So yeah, it doesn't sound easy as well, but yes, while I speak, it sounds little easy, but practically it is really going to be difficult. Whether RCM will be treated as exempt like transport? No, as I discussed, depending on how your transport, your GTA is, if it is registered, then it will be registered, otherwise it will be URD. Yogesh sir, please confirm this clause is applicable to all SSCs, meaning whether registered under GST or not. So my apparent view is yes, it is applicable to all SSCs, whether registered under GST or not. While tax authority will examine the RICO with the books, is there expectation that information should also match with GST records, returns filed with the authorities? My apparent answer is yes. See, because what will happen is while you are certifying the books of accounts, you will have to also ensure that whatever GST liabilities, ITCs which are claimed are also in line with GST records. Otherwise, your accounts may not give true and fair view of the financial positions, and hence this would be this is important to reconcile at all aspects. So typically what we do is while we finalize the tax audit, though 9(9)C would not have been completed, but we at least make sure that there is a basic reconciliation done when it comes to GST is concerned, wherein all the ITCs, all the liabilities are matched and necessary accounting effects are taken if there are any items to be considered. How this clause will be mapped with GST return 9(9)C, I don't see as of now. Apparently, the way this clause is, it will be really getting mapped. I think a lot of work needs to be done because there are multiple reconciliations which will be required while you do this 9(9)C. And here, as I said, our starting point or our basic data would be books, and hence there'll be a long way if this has to be tagged with 9(9)C. In case of person dealing in shares and securities, brokerage paid to broker is adjusted in cost, especially share security. Since breakup is not maintained in books, can disclaimer be given? Yes, apparently the answer is yes. Since it is not maintained, you will have to give disclaimer. However, as I said, the reporting under this clause is not for taxes. See, here the amount which has to be reported is of transactions, the expenses. So apparently, of course, I've not, frankly speaking, applied or I could really think of this purchase of shares and securities is concerned. But apparently, if this has to be reported based on my apparent reading, what I would report is full purchase or transaction value and not only expenses within that. So to say that tax portions are not reported, whole transaction value has to be reported. So yes, with this, I have answered all the questions which are available in chat box. Jayesh bhai, over to you.
Yeah, Vishal, thank you.
One more question popped up, please.
1 second. What is the basic purpose of this recording? As I said, I apparently felt that there are two basic purposes behind this. Is one, sooner or later they are going to tag this to your 99C. Second, whatever URD transactions are concerned, they would want to tap those vendors or dealers. This is what I feel. Can you give some briefing on ICDS disclosures? ICDS disclosure, as I understand, you refer to para 13. Yes, there can be some disclosures when it comes to ICDS is concerned. So basically, ICDS are the standards which are issued by the department as against the standards which are issued by the income tax institute. So any different in transaction value, for example, AS2 says that your closing stock has to be excluding refundable taxes. Now, hypothetically, while we have concluded that section 145A inclusive exclusive will not result or will not result into any difference in profit. However, for the sake of understanding, assuming when you compute your closing stock and when it comes to income tax is concerned, and if there are different values, due to which different values, if your profit increases or decreases, you will have to report under clause 13, which talks about ICDS disclosure. So this is the broad disclosure when it comes to ICDS. So any increase and decrease on account of following accounting standards as far as your books is concerned and ICDS as far as your tax computation is concerned, you have to report those numbers in ICDS disclosures. Yeah, Jayesh bhai. Should I stop sharing now?
Yeah, please. If you can just stop sharing your screen. Thank you, Yogesh bhai. Yogesh bhai, actually,
before you conclude, sorry, Jayesh bhai, for the members, I'm going to share this presentation and my contact details are available on the presentation. So as I said, in case you all come across any other such situation or any other queries which you feel you need to discuss or clarify, I'll be happy to help on those.
Thank you, Yogesh bhai. Thank you. Thanks a lot, Yogesh bhai. So, Yogesh bhai, actually, at the beginning, as I said, it's a routine topic, and every year we are taking these sessions on the close by close discussions on the tax audit. But truly speaking, sir, after your deliberations, I can say, even though it's a routine topic, but the way the changes are there and the information they've asked for, truly speaking, without these sessions, the completing the audit would be, for me at least, it was little difficult. But thank you very much, sir, for your times and efforts for us and for our members and for JB Nagar CP Study Circle. There are some announcements before we conclude. Tomorrow also we have very important sessions. It's a physical sessions at the Hotel Kohinoor Continental. The first sessions would be on the understanding of the financial statement in the context of GST, and wherein the eminent speaker CA Sunil Bhai Gabawala, he is going to join us tomorrow morning 8:45 a.m. at Kohinoor. And the second session would be on the recent amendments in the CARO and the Schedule 3, the Companies Act, wherein our Central Council member CA Vishal Bhai Doshi is going to visit personally at JB Nagar CP Study Circle and enlighten us on the very important topic. So both topics are the very important for the time being. So we request each and every members and participants to please join us physically at Hotel Kohinoor tomorrow morning without fail. So with this announcement, I think now I should hand it over to the Deputy Convener CA Purvi Bagaria ji to propose hearty vote of thanks to the speakers and the members and the coordinators. Over to you, Purvi madam.
Thank you, Jayesh. On behalf of the JB Nagar CPA Study Circle, I wish to extend a big and huge vote of thanks to our today's speaker, CA Yogesh Amalji, for his deliberations on the topic important clauses of tax audit. We thank you, sir, for your very detailed presentation, for highlighting the unusual in the usual clauses, and also for your discussions on the new clauses, specifically clause number 44, which was highly anticipated by the participants. And we also appreciate that you took the queries of the participant throughout the session, thereby making the presentation a little more informative and useful for them. We would also like to thank all our participants today who spared their time and during the tax season and attending the session. I would also like to thank the coordinators for today's event and the convener for arranging the session. Thank you all. Thank you so much.
Thank you everyone.
Thank you,
Thank you,
everyone.
Madam. Thank you, Vijeta Madam. Thank you, Speaker Yogesh Bhai.
Pleasure.
Guys, so
Thank
concluding
you.
today's session.